Welcome back to the channel, traders. Today, we're diving into the top indicators you need to master for successful cryptocurrency trading. Listen, I get it. Crypto can feel like the Wild West out there. That's why I'm breaking down these technical indicators. They're your roadmap to navigating the markets and coming out ahead. Whether you're just starting out or you're a seasoned pro, these tools can help you make smarter, more informed trading decisions. We're going to cover 5 of the most popular and effective indicators: moving averages, RSI, Bollinger Bands, MACD, and Fibonacci retracement. So grab your notebooks, let's get started. First up, we've got moving averages, or MAs for short. These are like the OG of technical indicators. In a nutshell, a moving average smooths out price data over a specific period, giving you a clearer picture of the trend. Think of it like this. Imagine you're looking at a choppy ocean. The waves are going up and down, making it hard to see the overall direction of the current. Now, imagine you could somehow smooth out those waves, so you're left with a clear line showing you exactly where the current is heading. That's what a moving average does for your charts. There are 2 main types of moving averages: simple moving averages, SMA, and exponential moving averages, EMA. SMAs give equal weight to all price data within the period, while EMAs give more weight to recent price data. EMAs tend to react more quickly to price changes. Now, how do you actually use moving averages to trade? Well, there are a few different ways. One common strategy is to use 2 moving averages with different time frames, like a 50-day MA and a 200-day MA. When the shorter-term MA, 50-day in this case, crosses above the longer-term MA, 200-day, it's often seen as a bullish signal, meaning the price is likely to go up. Conversely, when the shorter-term MA crosses below the longer-term MA, it's considered a bearish signal, suggesting a potential price drop. Moving averages can also act as dynamic support and resistance levels. If the price is above a key moving average, that MA might act as a support level, preventing the price from falling further. On the flip side, if the price is below a key MA, that MA could become a resistance level, making it harder for the price to break through. Keep in mind, though, that no indicator is perfect. Moving averages are lagging indicators, meaning they're based on past price data. So while they can be incredibly helpful in identifying trends and potential support resistance levels, it's crucial to use them in conjunction with other indicators and your own analysis. Next up, let's talk about the Relative Strength Index, or RSI. This handy indicator measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the market. It's like a momentum gauge for crypto. Imagine you're driving a car and you're constantly slamming on the gas pedal, then hitting the brakes. That's not a sustainable way to drive, right? Well, the same goes for crypto prices. If a cryptocurrency has been going straight up for days on end, it's likely overbought, and a pullback might be in order. Conversely, if it's been in free fall, it could be oversold, and a bounce back might be on the horizon. The RSI is displayed on a scale of 0 to 100. Generally, readings above 70 are considered overbought, while readings below 30 are considered oversold. Now, this doesn't mean you should automatically buy when the RSI is below 30, or sell when it's above 70. Instead, use these levels as alerts, like a heads up that momentum might be shifting. For example, if you see a cryptocurrency with an RSI of 80, it might be a good time to tighten your stop-loss orders or take some profits off the table. Or if you're looking to buy, an RSI of 25 could indicate a potential entry point. The key with RSI, like with any indicator, is to use it as part of a broader trading strategy. Don't rely on it in isolation. Combine it with other indicators and your own analysis to make more informed decisions. Let's face it, the crypto market is known for its wild price swings. That's where Bollinger Bands come in. They're like your volatility radar, helping you navigate those choppy waters. Picture this, you've got a central moving average and then 2 bands that move around it, kind of like a price envelope. The wider apart those bands are, the more volatile the market is. The narrower they are, the calmer things are. But here's where it gets really interesting. Price tends to revert back to the mean. So if the price has been hugging the upper band for a while, it's more likely to pull back towards the middle moving average. And if it's been bouncing off the lower band, a move back up is more probable. Traders use Bollinger Bands to identify potential breakouts too. A breakout above the upper band can signal a strong move to the upside, while a break below the lower band can indicate further downside. Just remember, like any indicator, Bollinger Bands shouldn't be used in isolation. It's all about combining them with other tools and techniques to get the full picture. Next up, we're diving into the MACD, or Moving Average Convergence Divergence. This versatile indicator is like a Swiss Army knife for traders, providing insights into the strength, direction, momentum, and duration of a trend. The MACD is made up of two lines, the MACD line itself, which is the difference between two exponential moving averages, and a signal line, which is a moving average of the MACD line. It's like having a conversation between two moving averages, giving you a deeper understanding of what's going on. When the MACD line crosses above the signal line, it's generally considered a bullish signal, indicating a potential uptrend. Conversely, when the MACD line crosses below the signal line, it can be a bearish signal, suggesting a potential downtrend. But that's not all. The MACD can also signal overbought and oversold conditions. If the MACD histogram, which is the difference between the MACD line and the signal line, is above the zero line and expanding, it can indicate overbought conditions. If it's below the zero line and expanding, it can signal oversold conditions. Remember, like any indicator, the MACD works best when combined with other tools and your own analysis. Don't be afraid to experiment and find what works best for you. Last but not least, let's talk about Fibonacci retracement. This powerful tool is based on the golden ratio, a mathematical ratio found throughout nature, and it can help you identify potential support and resistance levels in the market. Imagine you're stretching a rubber band. When you let go, it doesn't just snap back to its original position, right? It retraces a portion of its move before potentially continuing in the original direction. Fibonacci retracement levels work in a similar way. They identify potential levels where the price might pull back before continuing in the direction of the trend. These levels are based on percentages derived from the Fibonacci sequence, with the most commonly used levels being 23.6%, 38.2%, 50%, 61.8%, and 100%. To use Fibonacci retracement, you first identify a significant price swing, like a move from a low to a high. Then, you apply the Fibonacci retracement tool to that swing, which will automatically plot the retracement levels. These levels can then act as potential support and resistance levels. For example, if the price is in an uptrend and retraces to the 38.2% Fibonacci level, it might find support there and bounce back up. Conversely, if the price is in a downtrend and retraces to the 61.8% level, it might encounter resistance there and continue moving lower. As with all technical indicators, it's important to use Fibonacci retracement in conjunction with other tools and your own analysis. But when used correctly, it can be a powerful tool for identifying potential entry and exit points in the market. That's it for today's video. If you found this information helpful, make sure to hit the like button and subscribe for more trading tips and strategies. Listen, becoming a successful trader takes time, effort, and constant learning. These indicators are just tools. They can help you make more informed decisions, but they're not magic bullets. So, do your own research, practice risk management, and never stop learning. The world of crypto trading is waiting for you. Happy trading!